Hello, and welcome to the LA Venture Podcast. This is Minnie Ingersoll, host of the podcast and partner at 10110. 10110 is a seed stage fund here in LA. All opinions expressed on this show by me and my guests are solely our own. Dan Zinn is the founder and managing partner at Rivonia Road Capital, a venture credit fund, and previously the founder of a $1 billion plus hedge fund. Venture credit didn't immediately sound super interesting to me until I got to better understand how Dan is helping venture-backed companies with non-dilutive capital. Also, Dan and I are classmates from about 20 years ago, and he is one of the most interesting individuals I know. So there's a lot that we're going to learn from him today. Hey, Dan.
Hey, Minnie. It's nice to see you.
Yeah, it's fun to be recording a podcast with you.
Oh, you said quite a high bar over there. That was, I'm going to have to do some real work to match it.
Yeah, you're going to have to be super interesting, like my introduction said. But let's start with Rivonia Road and start there and then kind of work backwards from there. So just tell me like kind of the basics of what you're doing there and maybe also compare it to venture debt and how, what's the difference there?
Sure. So I think, venture credit is not a word that has been really coined. And so basically what we do is we bridge the capital gap for venture-backed firms who originate assets, right, that are financeable assets that have maybe cash flows associated with them, or that are just like things that you can see, touch, feel, and turn into cash at some point. We help turn those assets into cash quickly for those businesses. We focus really on the underlying collateral, i.e. the things that a lot of online businesses originate these days, whereas venture debt really is more about just, debt, investing debt in a business and getting some warrants and hoping you make your return like that.
Got it. And so when you're talking about venture credit, I guess, it's not always a physical asset, right? So what would be examples of things that you could lend against?
So it's not always a physical asset like a car or, a house or something which actually has got nuts and bolts in it. It might be a cash flow stream, right? So it might be a royalty stream, right? And royalty streams are kind of predictable, and there are a lot of businesses that actually these days are disintermediating the traditional media market, and they have these royalty streams that they might own or they might be originating online, like they might be buying or helping artists or singers or songwriters monetize their royalty streams. So it might be something like that. It might be loans. A lot of loans are originated online these days. So you get consumer loans that are originated by lots of different avenues, kind of like, I'll give you an example, Prosper or Lending Club originate consumer loans. Those are not kind of nuts and bolts things, but they have a cash flow stream associated with them. And we can help release the cash or the capital that's embedded in those assets for the business to go and grow. So that would be another example.
And so, and are these usually like in my parlance, like a Series A company, a Series B company? Like how big does the company usually? What do they look like when you talk to them?
It's a really good question. So we actually deal with companies that are all the way, that really run the gamut. So we deal with really early stage companies that are in the seed stage, especially if their business model is really focused on originating assets online in some way, shape, or form. It's really helpful for them to start to speak to us early. And frankly, at that point, even though we might not necessarily finance a business at that stage, it's really helpful for them to talk to us so that they know a path towards that financing. Very often you want to think about these things early so that you can put in place the structures and the systems and the processes to enable financing to happen quickly. And so it really runs the gambit all the way from really early stage to pre-IPO potentially.
And so will you give me free advice on whether my business looks like something like, if I'm not sure about whether, venture credit is right for me, can I just call you up?
We don't charge anything for advice. Just like you know, so we're actually in the business to help businesses. That's the way I see it. We're in the businesses to help founders. It's a really kind of unfamiliar territory for most founders. Most founders don't really understand the capital markets as well as they should, and nor, frankly, at some point they need to. And we're there to bridge that gap. We've had over the last 10 or 15 or maybe even 20 years now since we kind of left business school, this is massive boom in online stuff. And I don't think the capital markets have kept up. I think the capital markets are so way behind.
I think of venture debt as Silicon Valley Bank, Square One Bank comes and right after you raise your Series A, they offer you like 30 or 40% of that Series A amount in a credit facility. And it sort of seems like a playbook now. And I think you're taking a much more bespoke model. Is that a fair characterization?
Yeah, no, it really is a fair characterization. I think venture debt, is something which has been around for a long time. Traditionally, venture debt providers have a formula. That formula is pretty much exactly as you described it. In return for what they provide in capital, they get warrants and some type of like coupon or whatever it might be. But traditionally, that's a loan directly to the company, and it sits in some sort of seniority relative to like the other equity in that company, right? And it's not bespoke. I mean, it's really an off-the-shelf solution. I mean, you'll very, very rarely see a venture debt company come in that says they can do anything with outside of that box. Mm-hmm. But we look for more kind of discrete things, and we look to price those things in a very sophisticated way, which allows the maximum release of capital for a business.
Great. So we can come to you for free advice, and I would. And the reason that we're talking today is I certainly would, in part because of you've got so much experience in this field. So let's fully rewind and go back to like Dan Zinn growing up in South Africa, and just how did you go from South Africa to Harvard Business School, which is where we met?
It is where we met, and thankful for it. It was a lot of fun. It was a fun couple of years, and I learned one or two things. So it was just somewhat fortuitous. I grew up in South Africa, and I was kind of lucky to actually make it out alive in most instances. Like, it wasn't like I was destined to go to Harvard at any point. I was kind of looking to get out of South Africa at the time. I'm always looking for an adventure of some sort, and it was really an adventurous move for me.
What was South Africa like? Like, you were in apartheid when you were growing up, right?
Yeah.
What was that like, living through that?
It's I think about it often, and I remember even at business school, when I first left, I only left South Africa in my mid-20s. I came straight to Boston with like a pair of shorts and a sweater, and literally, yeah, literally. Well, maybe I had a couple of pairs of jeans as well, but I didn't have much more than that. And I remember speaking about this in the context of HBS as well in a classroom discussion, and we were talking about what it was like to grow up in South Africa. I mean, it was a place where you knew that something was wrong. Right. There was something deep inside you that knew something was wrong, but it's just kind of how the world is in your life. And so you just kind of go and do the things that you do, but it was for sure a highly challenging environment to be in. There were all sorts of issues like sanctions from, the US, and we vote in this country, and it's not just splitting hairs, but they're real issues. But the type of issue that I voted on in South Africa for the first time in 1992, I think it was do we open the country up? Do we let Nelson Mandela out of jail? Do we unban the ANC? Yeah. Or do we totally shut down and go backwards? Like, those were the two options you could, literally the vote was yes or no.
Wow.
And the white population in the country, we were the only population that had a vote, voted almost overwhelmingly in favor of yes, at least in the context of a vote, which is an extraordinarily hopeful thing. And so maybe that's a long story, but it was an incredible period of time in many respects to grow up somewhere so different from the world that we know it at the moment.
Right. Whew, yeah. And so then that's a big transition to show up at the Harvard Business School campus with your sweatshirt and jeans on.
Right.
But then you don't just go from that to having $1 billion plus hedge fund. So,
Right.
so how did you start that journey? It's Orange Capital, right? Was your hedge
Correct.
fund?
Yeah, that's right.
How did you start that, and how did you grow it?
Yeah. So it was, again, somewhat on the journey, on the adventure. I mean, I see life as a journey. This is all a journey, and you better enjoy it, and you better do some interesting things along the way, because ultimately, there's no destination that I know of that is necessarily satisfying. So that's another subject entirely, maybe a philosophical discussion later on. And so I went from business school I worked at Goldman Sachs for a few years, about 3 years, between London and New York. And that was fun for a little while, but just for me, I think I'd learned everything that I needed to learn after 3 years, and I wanted to make a move. And so a couple of friends were starting a fund. We raised, about $60 million at the time. And it didn't just happen like that. I mean, you have to have people who trust you. But we were fortunate to have that. And also we had the wind at our backs. So that was kind of like the internet era of hedge funds. And and so there were 3 guys in a room who looked at each other trying to figure out what we were going to do with this capital, really. And being as adventurous as we were, we got on an airplane and headed to China, because where else do you go? I don't know. I couldn't think of anywhere else. Just 2005, and the Chinese capital markets were totally undeveloped. In many respects, they were quite a mess, actually. There were Chinese domestic markets that were non-functional and not open to outside investors. We were very successful in investing in China through some of the more established markets like Singapore and Hong Kong. But it was really before anybody who was sitting in New York in a suit was even thinking about China. That is for certain.
Yeah.
And that's always really kind of guided my path. It's where's the opportunity? Where are the underdeveloped markets? Where are people not?
China 2006 or something. Were you in, tier 1 cities, tier 2 cities? Were you going to manufacturing? Like, what did it feel like then?
It's, even the tier 1 cities, which let's call the 2 big ones, like Beijing, Shanghai, and there are obviously some others, they felt like, really emerging markets. I mean, they were very underdeveloped. Those are the tier 1 cities that we visited, but we visited tier 1, tier 2, tier 3 cities, and the tier 3 cities might have 5 million people in them. I mean, they're comparable to some large cities in the US, but it was the Wild West. I mean, it was really the Wild West. It was me and maybe my partner at the time, literally stepping into a world where sometimes I'd wake up in a hotel room and look outside, and I would think I was on another planet.
Huh.
We went anywhere where there was an interesting investment opportunity, where we could meet the management team, see the assets, see what they were doing, and try and understand whether there was value, underlying value in that business and the proposition.
And so you went from 60 million, you made some good investments then.
Yeah. I think another thing that we did, which, it's a hedge fund, it's different. You have a different time horizon from a venture fund, where you're thinking in, 5-10 year periods of time. In a hedge fund, you're thinking in really 6 months, 12 months periods of time. And so the other good thing that we did was, frankly, get out of the capital markets almost entirely when we saw the instability in the credit markets in 2008 and 2007.
And at some point you walk away from this. I'm taking you back to lending and what you're doing now. But so at some point you walk away from your hedge fund and start Express.
Right.
So give me the quick version of what Express was doing or still is doing. Yeah.
So in 2013, left Orange. It was an incredible run. And I looked at, where I thought the opportunity was. Again, the dislocation, like, where is the capital not going? Who needs the capital? And that's always informed my investment decisions, whether it was China or whether it was, the alternative credit markets in the US, small businesses. And there'd been an implosion of and vaporization of credit availability to most small businesses in this country post 2008 and 9.
Oh, okay. So that's what happened. So after 2008, 2009, you stopped being able to get a small business loan, I guess.
Yeah, for all sorts of reasons. I think the main reasons were banks just became more and more risk averse. A lot of banks went out of business. Many of them consolidated. Small business loans have never been a profitable business segment for the banks. And so, we started up a business to help those businesses and to allow them to access capital very, very quickly and at a reasonable cost, I think was our motto. And, that business still operates out of Santa Monica, California today in 2020. So it's been a pretty good run.
So Express was helping small businesses access credit, but Rivonia Road is helping venture-backed businesses access credit. Why did you move from one to the other? It sounds quite similar to me.
Express is a much more retail-driven model. It's actually it's an originator, front-facing B2C type model, and our marketing strategy is all B2C. And so I think about that more as like an operating company, and that operating company because it makes loans, it needs to figure out a way to have an efficient balance sheet. And as I went through the process of building a business, I realized very quickly that there was an opportunity in financing companies like Express, right? So where Express is the front-facing retail-driven operation, its balance sheet needs to be financed, right? And there are not a lot of good alternatives for that in the market. It's kind of like a bit of an oligopoly. And so I was sitting there in a situation where I understood the operator, I understood the company or the venture-funded company, but I also understood these pockets of capital, these deep institutional credit markets. And so Rivonia Road was really born to fill that gap. And as far as I know, we're the only guys out there who are operators and investors, and provide credit to venture-backed companies. It's a very unique thing, and it puts us in a very unique position.
How much money do you give people at Rivonia?
Depends. How much do you want?
That's what I was thinking. This is great.
That's a good question. We will do all sorts of things at Rivonia, right? So we'll do anything from kind of, fairly small deals in the kind of low single millions, right? To we've just completed a transaction, which is a $75 million transaction. So that's kind of our wheelhouse, is in the sub $100 million. We like to speak to businesses at the earliest possible stage of their development, and maybe do something which might be a little bit, might be considered small for us in our balance sheet, but really what it is it's a seed, and we like to plant that seed, which gives us a window into the business, just like venture guys invest. It starts small and then gets bigger. That's how we think about providing credit as well.
And then do you stay involved? Like, do you, if you're making $75 million, it's not investment, but investment line of credit, I guess.
So I do think about it as an investment, actually. I think about it as an investment in the debt of the business or the credits of the business. So we're more concerned about like the downside, protecting the downside with having some exposure to the business's growth prospects, because we want to have both. And the best credit investor out there will be concerned about your growth as well. They'll want you to grow, right? So if you're ever looking for credit and you can find a credit guy, a credit investor who is also invested in your equity, they're thinking about the business like you're thinking about the business, right? What you don't want to be is at odds with your credit provider, which is the case with most banks. It's the case with most credit funds. It's a somewhat acrimonious relationship, right? We like to be in the middle of both.
What are your motivations for doing this? Like you obviously stepped away from Orange. Why build Rivonia? Why build Express?
Yeah, it's a good question. By the way, sometimes I ask myself that question, and quite often, because it's an interesting path. A lot of people, they like become an investment banker, and then they're an investment banker, and they go through their entire career as an investment banker. And I like to learn something, and I like to use what I learned to move into something that I feel is more expansive at that time. And so I don't like to jump into things that are fully expansive, and because it's just not maybe how I think about the world. There are some people out there, and incredible people, who can, start an electric car company and then decide they're going to Mars, and then, and then I think, my motivation really, when I think about what I want to, comes down to like interesting question, like what are you doing on this planet, right? Like what are you trying to accomplish? I believe we're here for a journey, right? And I think to myself, what are the skills that I can use to enable that journey in a way that has like maximum impact? And I know what my skills are, right? I mean, I know that I'm good in this business. I know that I enjoy it. So when I say this business, it's business in general and investing. And so how can I paint a picture such that when I look back on my life, it's something which I like to look at.
You want to have an impact. So I'm a venture-backed business.
Yeah.
And the answer is, with your non-dilutive capital, I can grow faster, mostly.
Absolutely. So let me give you an example of that. I think it might be because we've spoken in generalities, and like I'm really good at speaking in generalities. Sometimes I'm not good at like figuring out whether people I'm speaking to actually understand those generalities. so sometimes it's good to be more specific about it. And so, as an example, we've just closed on a deal which is going to provide $75 million of financing to a business broadly in the mortgage origination space. Recently did a Series A. They've raised maybe $10 million in total. But the residential real estate markets, as you can imagine, are highly capital intensive. Ultimately, without capital, it can't grow.
What would be the alternative? Yeah, so that's obvious. Yeah. Like it's a big, but what would be what else? I don't want to say like who are your competitors, but what else would they do?
I don't actually know the answer to that question, by the way, because at an early stage, they have to find a provider of capital that believes in their business model and their abilities to scale, right? And so it's a lot of hard work when you're a really early stage kind of Series A company, convincing the capital markets to provide $75 million of capital if you've raised maybe 10, let's say. And so what we give them is the capability to 10x their origination almost immediately. So to take those venture dollars, go back for another round and show the venture dollars that they actually show their venture investors that they have access to the capital markets, which is almost an enabler for this business. So that's where we come in. It's early. We believe in the business. We do enough work, not just to go in behind, a venture investor and say we're going to put some debt in there and give us some warrants and it's like a venture debt, but we actually put in the work to really understand the business model and make a commitment.
You're like a VC in the diligence.
Totally. In fact, I would say that the work that we've done in understanding this business, and not to say that you guys don't do.
I knew where you were going.
Where was I going exactly? The work that we've done is because we're in some ways so you guys are, and I'm not going to dilute, like venture investors are. How big is the market, and how good is the management team? Like those are the two big questions, and those are incredibly important questions as a venture investor, right? But in general, like you're not in a situation where you're getting 10 out of 10, right? For that answer.
I can lose on a couple investments. You can't, I think.
That's exactly right. I can't lose on a couple. I can't actually lose on any.
Right. Back to the philosophical then. Thank you. What have been some of the big learnings that you didn't know when you were, 20 years ago?
I would say the first thing is just getting really in touch with like my intuition. You can do as much work as you can do. You can do analysis until forever, right? And I think some of the best decisions I've made have been intuitive decisions. Decisions where I did not apply all of my, the analytical side of my brain to the situation, and I've really kind of felt into them.
How do you get in touch with that intuition? I mean, I agree.
Yeah.
I think I have great intuition, but how do I know what it is?
I think you have to establish like a baseline level of trust in yourself.
Mm.
Very often we're so analytical because we don't trust our own capabilities to make decisions quickly and from a point of more limited information. Sometimes those decisions are the best decisions because they actually come from a point of maximum information. We're just not mentally integrating that information. We're not, when I say mentally, we're not consciously coming to the conclusion. And so I think it's, a lot of that is just getting to know yourself and I think, and trusting yourself.
Mm-hmm.
So, how do you get to self-trust? I think everybody people might have a different path to that. We might have to get somebody else on the podcast to provide advice for.
It's a different show.
It's a different show. Yeah, exactly. So I think that's the one. The other one, which I think would, there's a mentor of mine who came out of the same business school that we came out of and was an extraordinarily successful hedge fund investor in his day, and he's kind of closed down that fund, but he's kind of I would consider him one of the greatest in that business, certainly an incredibly brilliant guy. I would walk into his office just before I left Orange, and I would say, just looking for something to rub off on me, listening for some wisdom and some mentorship. And I'd ask him questions, and he said to me, and this isn't for everybody, right? Because some people might view the world differently. He said, when you set your path, he's like, what is your audacious goal? What is your audacious goal? And I think about the world sometimes when I make my decisions about what my audacious goal is. And I think it's important, especially as a young business, in really defining what the landscape looks like and understanding how big you can be, what things you can do, and really defining what that audacious goal is. It's beyond anything which might even sound like it makes sense, but it's as big as possible. And so that's how we achieve great heights, I think. And so I've sometimes been successful in following that advice, and sometimes not. But it's definitely something which sticks in my mind.
I love that. They kind of dovetail for me, which is my audacious goal and being in touch with being able to admit it and know what it is. Anyhow, that's great. I appreciate that. Well, Dan, I think I'm going to let you go now and say thank you for sharing your view on life, as well as I'm just excited for the venture-backed companies here in LA to know you're here and you're a free resource if they want to consult with you.
Anytime. I mean, I'm around, and I'm always here to talk.
Great. Thanks so much.
Thanks, Minnie. Great seeing you.